We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets.
U.S. equities snapped back. The S&P up 1.7%, NASDAQ over 2%, powered by a strong kickoff to earnings season and a suddenly dovish Fed hinting that rate cuts could come sooner than expected. But beneath that optimism, cracks are showing. Regional bank loan stress, subprime defaults, and a spike in the VIX sent investors fleeing into gold and treasuries. In Europe, France steadied the bloc with political calm, while Germany's industrial slump and the UK's softening labor market kept recession fears alive. And across Asia, China's deflation deepened ahead of its crucial policy plenum, while Japan's political uncertainty and a surging yen underscored a region on edge.
Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
Our mission today, recapping the week ending October 17th. A week where, markets clawed back some serious ground, but they did it with this really nervous energy. The S&P 500 climbed 1.70%, NASDAQ jumped 2.14%, looked like a solid rebound, from the slump. But when you really look under the hood, this recovery feels kind of fragile. It feels like it's built less on fundamental certainty and more on this collective, almost anxious hope.
And that tension, that exact conflict, that's the heart of the story right now for every portfolio, isn't it? Investors are basically trying this high wire act. On one side, they're super keen on pricing in that Fed pivot, the promise of lower rates, but on the other, they're dealing with some deep-seated problems. Credit jitters popping up right here in the U.S., ongoing geopolitical stuff, and honestly, some real measurable economic weakness overseas. Volatility, it didn't just vanish, it just shifted its focus.
Okay, let's unpack the Americas first then. We saw the indices jump. What were the specific immediate things driving that lift, beyond just, general relief?
Two really clear drivers, I think. First, the Q3 earnings season. It started off surprisingly strong. We heard from the big banks, JP Morgan, Citi, Wells Fargo, and wow, nearly all of them beat expectations. And this isn't just squeaking by. So far, something like 86% of S&P 500 companies reporting have beaten the consensus forecasts. That's a huge shot in the arm for confidence.
Right. And the second driver, the pivot talk itself. Chair Powell, other Fed officials, they sounded, noticeably more dovish. They weren't just nodding to inflation maybe easing off. They were explicitly talking about downside risks to employment and hinting that rate cuts could actually happen sooner than maybe we thought.
Exactly. That's the key language. They suggested cuts could come even if inflation is still above target. And the market heard that loud and clear, translated it straight into a lower cost of capital, basically justifying higher valuations right now.
Okay, so the market sees that language, thinks green light, starts pricing in the shift.
Precisely. But here's where it gets really interesting. Let's use an analogy. It's like watching the market try to drive a car with the gas pedal absolutely floored.
Yeah.
That's your Fed pivot optimism, but at the same time, they're slamming on the brakes. And those brakes, that's the anxiety bubbling up in the credit market.
Tell us about those brakes then, because despite that strong equity rally, the credit market definitely got cold feet midweek. What happened there?
It really did. And it points to some deep underlying vulnerabilities, I think. We got some pretty troubling news about fraud-related loan issues popping up at regional banks. Sort of a reminder that these higher rates, they're finally starting to trigger defaults in the riskier parts of the loan market. And then you had some recent pretty high-profile bankruptcies in the subprime auto sector. These aren't just isolated incidents, right? They're symptoms. Symptoms of high interest rates really biting into consumer debt.
How much did that nervousness spike the fear gauge? The VIX?
Oh, significantly. That specific worry about credit. It sent the VIX, the market's standard measure of expected volatility, rocketing to its highest level since back in April. And the flight to quality was immediate. You saw gold surge to fresh highs. And maybe most critically, the 10-year Treasury yield dropped below 4% for the first time. again, since April.
Wow. A Treasury yield below 4% at the same time Nasdaq is jumping over 2%. That contradiction says it all, doesn't it?
It absolutely does. It's the perfect illustration.
Yeah.
Investors were buying risk with one hand stocks because they believe the Fed will cut rates, but with the other hand, they were piling into safety gold, treasuries, because they're afraid the Fed is only cutting rates because something fundamental is actually breaking in the economy.
So the main takeaway for the U.S. is the market's warming up fast to the idea of rate cuts, but these credit risks and real questions about economic resilience, those are the cold feet holding it back from a full-on sustainable sprint. Okay, let's shift gears. Let's head across the Atlantic. Did Europe manage to keep the momentum going, or did those U.S. jitters kind of infect the STOXX?
Well, Europe ended up cautiously optimistic, you could say. The STOXX Europe 600 did edge up, about 0.37%. But honestly, the picture across the region was really all over the map. You had France acting as this major positive anchor, but then Germany and the UK were definitely struggling.
Okay, let's start with the ankle then. France's CAC 40 really outperformed, jumped, 3.24%. Why the sudden confidence boost in Paris?
It was basically political risk being taken off the table, which markets always love, right? Prime Minister Lecornu managed to survive a couple of no-confidence votes. And the key was strategically suspending those really controversial pension reforms. Remember those, the ones about raising the retirement age. They'd sparked massive protests, strikes. So by hitting pause, they avoided what could have turned into a really nasty political and social crisis. And the market just breathed a sigh of relief, basically. Stability restored.
Makes sense. But that German drag was definitely real. Germany's DAX finished down sharply, lost almost 1.7%. What's the root cause of this ongoing weakness in Europe's biggest economy?
It's really the industrial core that's weakening. And it's facing kind of a perfect storm. We saw more data showing slumping industrial production, especially plunging auto output.
Right.
Plus, you've got softening orders coming in. This isn't just a cyclical dip anymore. It feels more structural. You've got high energy costs still biting and crucially weakening export demand, especially from China. Germany's still the heavyweight in the Eurozone, right? So if its manufacturing engine stalls like this because of these structural problems, the whole bloc feels that pressure.
Yeah, that definitely tracks. Now over to the UK. The FTSE 100 struggled too, finished down about 0.77%. What's the story unfolding in Britain? Is it just stagnation?
Stagnation is probably the kindest way to put it, yeah. August GDP, it came in at a tiny 0.1% gain, and that was after a decline in July. It's really an economy just treading water, trying very hard not to slip into recession. And the critical change now, I think, is what's happening in the labor market.
Right, because for so long, the UK economy seemed to be held up by this really resilient, tight labor market that was providing some consumption stability, even with high inflation.
Exactly. But that resilience looks like it's starting to erode now. Unemployment actually ticked up to 4.8%. Payroll employment slipped a bit in September. And wage growth, if you exclude bonuses, it eased slightly to 4.7% year over year. So the labor market isn't really doing that heavy lifting anymore, masking the lack of investment and growth elsewhere. And that means the outlook for consumption in Britain just got quite a bit darker.
Okay, so summing up Europe, holding steady for the moment thanks mainly to France avoiding a crisis. But Germany's industrial problems and the UK's softening labor market mean those recession risks are still very much on the table, especially looking towards winter. All right, finally, let's pivot to Asia. Investor patience there seems to be wearing pretty thin, especially when it comes to Beijing's policy response. Japan's Nikkei was down 1.05%. What's creating the uncertainty in Tokyo?
Japan's wrestling with a couple of things: domestic politics and external risk, basically. Domestically, talks are still ongoing to try and form a new ruling coalition. That's because the key minor partner, the Komeito Party, actually exited the government. So this whole coalition shakeup creates immediate political uncertainty about who's going to lead the LDP, who's going to set the economic agenda going forward.
And on the monetary policy side, we're still watching the Bank of Japan. They seem pretty determined to stick with their ultra-loose policy, don't they?
They absolutely are. Markets are definitely dialing back any expectations of rate hikes ahead of the late October BOJ meeting. Governor Ueda keeps stressing this data-dependent approach. But interestingly, amid all this uncertainty, the yen actually strengthened quite a bit, hitting the 149 per dollar range. That reflects safe haven demand, right? Global investors pulling money out of riskier assets elsewhere and parking it in the yen.
Okay, contrast that sort of conservative risk profile with the outright selling we saw in China. The CSI 300 down over 2%, the Hang Seng dropping nearly 4%. That's a huge vote of no confidence.
It really is.
Yeah.
And frankly, the data kind of validated that pessimism. China is facing this relentless deflationary pressure. September CPI actually fell 0.3% year over year. And get this, the PPI, the Producer Price Index, it dropped for the 36th consecutive month. 36 months. That's a profound signal that the industrial engine just lacks pricing power and demand is weak. Yes, core CPI was up a tiny bit, but nowhere near enough to signal any kind of broad price momentum coming back into the economy.
So after all those negative numbers, the market must be absolutely starving for some kind of signal from Beijing. What specifically are investors hoping to hear this week?
All eyes are now squarely on the upcoming Fourth Plenum meeting, scheduled for October 20th to the 23rd. This is where the officials are expected to unveil the next 5-year economic roadmap. And the market isn't just looking for minor stimulus tweaks. They're looking for a real commitment, a structural shift towards boosting consumption, a clear plan for the housing crisis, and some definitive clarity on tariffs. China's economy is clearly losing steam, and the near-term outlook for the whole region really hinges on whether the party delivers a genuinely bold economic direction this time.
Okay, time to look ahead. This coming week, October 20th through the 24th, feels absolutely packed. High-stakes data points that could really determine whether this whole Fed pivot narrative lives or, well, dies.
Yeah, for Fed expectations, the absolute crucial data points land in the U.S. on Friday, October 24th. We get the U.S. Consumer Price Index, the CPI, and the weekly jobless claims data. This is really the ultimate showdown for the current market mood. This single report could either validate all those dovish signals we heard from Powell last week, or it could just completely obliterate them.
And on the global growth front, China pretty much owns Monday, October 20th, right? We get their Q3 GDP growth rate, retail sales, and industrial production. A huge dump of data, and it's tied directly to whatever headlines come out of that party plenum. A disappointment here could easily overshadow any positive policy language.
Exactly. And we also get a really vital industrial pulse check for Europe on Friday. That's Germany's flash manufacturing PMI. If that data shows continued deep contraction, it's going to weigh heavily on the whole Eurozone sentiment and basically confirm those structural fears we were just talking about.
And we can't forget the Bank of England test. The UK reports inflation figures on Wednesday, October 22nd, and then retail sales on Friday, October 24th. This data will really test the BOE's resolve on rates, won't it? Do they hike again to fight those sticky prices, or do they pause because of that softening labor market? Tough spot.
Very tough. And just rounding out the U.S. calendar, don't forget the Conference Board Leading Economic Index, LEI, on Monday, and then existing and new home sales data later in the week, Thursday and Friday.
Okay, we've crunched the data, assessed the mood. Based on how fragile last week's recovery felt, you need to be aware of the top 5 dangers that could hit your portfolio next week. What are they?
All right, number 1, the biggest immediate danger. U.S. inflation surprise. If that CPI print on Friday comes in hotter than expected, showing inflation pressure is still persistent, it just instantly throws cold water on every single dovish Fed bet that fueled last week's stock rally. The risk of the VIX spiking again is huge there.
Okay, number 2.
Second, China's plenum disappoints. If that next 5-year roadmap comes out and it lacks truly aggressive stimulus or clear structural commitments to boost consumer demand, we could see an acceleration of equity outflows from Chinese markets. And that would ripple through commodities globally, too.
Got it. Third risk.
Third, UK inflation resilience. If the data on Wednesday confirms that UK prices are still stubbornly sticky, it's going to seriously complicate the Bank of England's strategy. They risk getting properly stuck between a stagnant economy and ongoing price pressures. That's the classic stagflation trap.
Right. Fourth danger.
Fourth, German manufacturing weakness. If that PMI data confirms continued contraction in Germany's core industrial sector, that could be the trigger. The trigger for a broader, more decisive downturn in overall Eurozone sentiment, basically proving the continent can't easily shake off those high energy costs and weak global demand.
And finally, number 5.
And fifth, Japan's political resolution, or lack thereof. If they fail to quickly form a stable new ruling coalition after that recent party exit, that's just going to add another layer of market unease in Asia. It could potentially force even more capital into the safe haven yen, which then tightens financial conditions for Japan's exporters. It's a feedback loop.
Okay, quick summary then. Markets ended the week higher, yes, fueled by a strong start to earnings and that distinctly dovish tone from the Fed. But the nerves are clearly frayed. You can see it in that massive safety trade into gold and treasuries. Investors are essentially making this huge leap of faith, betting the Fed pivot is definitely coming, almost regardless of the pain points showing up globally.
And that leap of faith, look, it's a risky one right now. Banking stress, credit risks, they haven't gone away, they're persistent. And global stagnation is showing up clearly from Germany to China. So this coming week, that critical U.S. CPI report, alongside China's crucial data dump and whatever policy signals emerge from Beijing, these could definitively tip the scales one way or the other. So the question for you, the listener, the astute investor, is really this. Are you positioned for the pivot, for the potential reward of lower rates? Or are you positioned for the pain points, the potential consequences of the economic frailty that might be forcing the Fed to pivot in the first place? Something to think about.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format. AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold. Built by Flamingo's Research and Advisory.